Hello. We're taking a look at a seriously trending company right now. This is called Party City. It was actually up 29%, almost 30% yesterday, while it has been down a lot in the past year. You can take a look at the 5-year chart here. You will see that it's been down significantly. Now, after this insane increase, it is now trending, of course, and people are potentially having some fear of missing out. But are they really missing out is what we're going to be chatting about in this video. We're going to examine the financials of the company and see whether it makes any sense to be entering right here. Now, this one is a company that is potentially having a little bit of a squeeze right now. I mean, after being down so much, you could potentially see it abruptly going upwards for a little while. As long as, a lot of shorts are actually trying to cover. You can kind of see here that the outstanding shares are about 112 million. So they are not too many, frankly. And also, the company's financials are not terrible in terms of how expensive it is. That is. Now, you can see that the P ratio is rather low here, almost 2. And it's been in negative territory as well. I mean, the company is losing money. Sometimes it is making a little bit of money. But the price to free cash flow is negative because the company can't really make, consistent free cash flow at least. And so we're going to examine this in a little bit more detail. But this retailer could potentially be at least an interesting opportunity, maybe. Okay, what is this about though? What is this company? So let's take a little bit of a quick look at the company profile. This company designs, manufactures, sources and distributes party goods worldwide, and you will see that it operates on retail and wholesale. It offers paper, plastic, tableware, metallic and latex balloons, Halloween and other costumes and things of that sort. So, as you can understand, this is basically a commodity company that is actually not really having any proprietary stuff here. And I do like to be entering companies that do have some sort of proprietary aspect on them, about them. Because then it's a little bit tougher for other competitors to kind of do the same thing and be copycats. Now this one, of course, is selling something that a lot of other companies could be selling, and it's tough to actually pretty much compete in a space where you don't really have something that is like super out of the ordinary or super proprietary here. So you could be talking about a company that could be declining in terms of margins, for example, if it has more competition. Although this one seems to be doing a little bit better, kind of going up and down as well though. So it is a company that you have to be like super careful about because again, it doesn't really have something that you can't find anywhere else. And this can be a little bit problematic. Now, in terms of the 5-year revenue growth, you will see that it's been going up and down a little bit, but in the past 5 years, it's almost steady, a little bit lower than what it used to be actually. And in terms of the net income, it's been going in negative territory, and the same thing with the free cash flow growth here. The same thing with the total equity growth also going down. So it is a declining company in terms of what they are doing financially. This is, of course, something that you hate to see. Not only that, the company has quite a lot of debt. Debt to equity is actually rather high here, and you can kind of see it in the total liabilities. The company may not be making any free cash flow, but the total liabilities to free cash flow being a 96 potentially point to the total liabilities being super high here. And you can understand that with a debt to equity ratio that is so high, it means that the company has dropped their equity so low that the debt is a high multiple of its equity. And this is not a great thing to see, obviously, for a company. Okay, so let's take a little bit of a look at the financial statements next and see what's going on here. So, in terms of the revenue, again, of the company, it has been at a relatively steady level here, 2.3, 2.1, about the same and a little bit less, frankly. But in terms of net income, it's been going negatively. It's been going in negative territory. And it used to be positive, now it's going negative, but it's getting a little bit better. So that's at least a nice sign that the company could be achieving profitability soon. And in terms of the balance sheet of the company here, you will see that we are looking at total liabilities of the company at 2.6 billion here, and total equity at 82 million. So the total equity is many times less than the total liabilities that the company has, and also the total debt that the company has. So this is why we are having a very high multiple of total debt to total equity here, and the company keeps going down in terms of what they're having in total equity. So they are losing some of their equity here, which is not great to see. Okay, so what about the cash flow? So in terms of cash flow, again, remember the company's net income has been going down in negative territory, but there are some adjustments happening here because of, for instance, stock-based compensation, depreciation, amortization, kind of bringing this into positive territory, the operating cash flow. In terms of the investing activities, very little going on here. It's mostly capital expenditures, as you'll see. And in terms of financing activities, it's for the most part paying back some debt, then some other the previous year, like getting a little bit of debt. It's a little bit of a balancing act here. And in terms of the free cash flow, the company has been having some years where it's positive, some years where it's negative. It kind of has to do with how much they are spending in capital expenditures. Obviously, they're very, very close to just a few million in pretty much the amount of money that they're making, not just losing a little bit of money, losing a few million. And so, yeah, this is not a company that is steady in what they're doing financially, is the thing. Now, they could have been affected by COVID, that's for sure. Although back in 2018, for example, they were making like 16 million as well, is little, very little, and then they went minus 18. So I'm not really sure how much they were affected, especially when 2020 was a 26 million year. So they're probably just very, very cyclical in their operations, and maybe they are spending a little bit more to become more relevant and then be able to get some extra free cash flow going. Okay, so I want to take a little bit of a look next and see in our stock evaluation tool whether this could be a potential buy here. Now, in terms of the revenue growth of the company, it's been basically minus 0.1% pretty much. And so we'll have to go low here. We're going to go 0, 1, and 2. Let's just say that the company doesn't grow much or at all really in the next few years. The big problem is the net income margins here, because you can see that the 5-year average has been negative, minus 7%, and this may have a lot to do with competition. It may also have a lot to do with COVID. So you could be seeing a little bit of a pretty much a changing story here, because the company used to be positive back in 17 and 18, and these values are not really bad here, like using something like 5, 7, and 9 could be interesting, but they have had some negative years too. Again, I'm not really sure how much these were affected in terms of COVID, but I'm pretty sure that it makes a ton of sense that they were, because again, the company couldn't have been selling a ton during this period of time. And for this reason, I will go with net income margins that are low but feasible, 1, 2, and 3%, very, very feasible actually, especially when the company returns to their previous state. They could actually be doing even more, and minus 0.3% is what they did 2021, so you could be seeing them doing way, way better now that the world is kind of open again, for the most part at least. And in terms of the free cash flow margin here, you will see that in the years before, where things were normal, for example, they were near 93%, although this year, for instance, was 13%, so much, much less free cash flow. It's gonna be a little bit going back and forth here. I'm gonna go a little bit more conservative in terms of the free cash flow margins here. I'm gonna go 70, 80, and 90, and I'm gonna go 15% for annual return, because it is a risky proposition here. I don't really know what the company is going to be doing. This is a very, very small company, and I just want to see whether their current valuation is so low that it could be interesting to potentially buy right here. I hit calculate, and you will see that with this kind of values here that are not out of the ordinary, they are not too extravagant, frankly. We are actually in a buy zone for our medium and high estimates here, and our low estimates are still not a buy, but are not super far. So, you know, this company is interesting. I mean, and the thing around that comes from the fact that they have a very, very low market cap, like 229 million, and when they are making like 30 million a year, for example, in free cash flow, that's pretty good. And this points to a company that is rather undervalued. However, there is the trouble that the company is doing, you know, some years is doing negative free cash flow, some years positive free cash flow, some years are doing well, some years are doing bad. But again, they have been deeply affected by the pandemic, is the thing. And again, if you take a look, let's just actually take a little bit of a look at the max chart here, see a little bit more of how they have been progressing through the years. I think that if they don't really have any troubles in terms of debt, they could potentially stay afloat and do pretty well in the upcoming years. I wouldn't be surprised actually. So it may be a potentially interesting opportunity just to get a little bit for a cyclical play, because of course it's a cyclical sector and could and will do badly if we enter actually a recessionary phase. It's likely to go down even more potentially, or just stay pretty much go operate sideways. But in a market where things are going to be normal, this actually may be an interesting purchase. Again, as we are exiting the pandemic and as their numbers could actually get a little bit better, because they have been severely declined. They have been in a severe decline because of the pandemic. Now, what I would pay close attention to is the debt, the thing that I talked about quite a lot. And other than that, if a company manages to stay afloat, this could probably be okay. But the fact that they have this kind of a lot of debt here and equity that is going down could potentially have the board issue more shares, for example, in order to fund themselves or get some extra loans. And so both situations are not perfect, but of course you're going to be having some risk entering this one. So again, an interesting proposition. I just wanted to take a look because it is trending right now. Of course, you can always decide on your own based on the data. But thank you for watching, and remember to like the video, that helps a ton, and subscribe if you're not a subscriber. I'll see you in the next one, guys. Bye bye.